So next technique we have in capital budgeting topic is payback period. Now it is a non-discounted cash flow criteria. That means it does not take into consideration the time value of money. So it cannot be the sole criteria of evaluation because it ignores a very important uh, concept of time value of money. So let's understand what is payback period. It is the time duration required to recover the initial cash outflows. So let's say we are investing $1 lakh in a project. How much time it will take to recover that $1 lakh? That is payback period. It is the time duration required to recover the initial cash outflows. We need to accept, we can accept the project if payback is less than the predicted period. Ideally, we should not rely just on the payback period because it does not consider time value of money. So it is not that logical. It is not telling us about the profitability. It is just telling us about how much time it takes for us to recover our initial investment. This is more relevant for industries where products get outdated quickly, such as fashion and computers. Will prefer to use payback period. So those industries where the changes are very frequent and we need to move the inventory, we need to generate sales quickly, otherwise our products could become obsolete and new technology can come in, new trends can come in. So in case of such industries, it is better to use payback period becomes important. The quicker the payback is coming, the better it is. Simple method, easy to understand and use. However, the cash flows after the payback period are ignored. So that means if payback is happening in 3 years, all the cash flows after third year, fourth year, fifth year, sixth year, all those cash flows are ignored, and it also ignores the time value of money. So used only for primary preliminary screening of the project. So this cannot be the decision making technique like NPV was, PI was, IRR was, but this has to be just used to do the initial screening, just to get an idea about how many years, how much time it will take for us to recover our initial investment. In some cases, in some industries where time is very, very important, this can come into picture for those kind of industries. Let's look at an example to understand this better. Let's say company has invested $1 lakh in a project and following are the expected after tax cash flows. So payback period is when are we able to recover our $1 lakh. So after year 1, we recovered $20,000. After year 2, we recovered a total of $50,000. After year 3, we in total recovered $80,000. So after third year, only $20,000 are more to be recovered, and in the fourth year we are generating 40,000. So that means in half of the fourth year we will be able to generate 20,000. So the payback period comes out to be 3.5 years. So that means it is taking us 3.5 years to recover our initial investment based on the cash flows of the project. That is how we calculate payback period. Few features of the payback period: simplicity. It's very simple, easy to understand, easy to use. It costs less than most sophisticated techniques that requires a lot of analyst time. The risk of the project can be tackled by having a shorter standard payback period as it measures guarantee against the loss. The emphasis in payback is on the early recovery of the investment. Next we have is discounted cash flow criteria, discounted payback period. So one of the limitation of payback period was that it ignores the time value of money. Now that limitation is overcome by looking at discounted payback period, which is present value of cash inflow to measure the time required to recover the initial investment. The concept is the same as the payback period, except for the cash flow used in the calculation is the present value. It is the method that eliminates the weakness of the traditional payback period. Let's look at an example. So here Kim Corporation is considering an investment of $750 million with expected after-tax cash inflows of $175 million per year for 7 years. And we need to calculate the payback period as well as discounted payback period. So we'll first calculate the cumulative cash flows. So we can see that we need to recover 750. Out of that, we recovered 175 in first year. So remaining to be recovered is 575 after year 1. After year 2, 400 is still to be recovered. After year 3, 225 is yet to be recovered. After year 4, 50 is yet to be recovered. So we only need to recover 50 more. And in the 5th year, the amount we are able to generate is 175. So we can clearly see that payback period is more than 4 years, but less than 5 years. So how do we calculate this? This would be calculated as 4 plus, what is the amount yet to be recovered? 50 divided by what is the amount we are generating next year? 175. So 4.29 is the payback period. That means it is taking us 4.29 years to recover our initial investment of $750 million. Let's look at discounted payback period now. So for discounted payback period, we consider discounted cash flows. And we'll do the same thing again. So if we look at time value of money, we look at discounted cash flows, then how much it is taking for us to recover 750 based on discounted future cash flows. So now it is taking us more than 5 years. So based on discounted cash flows, it is taking us 5.88 years to recover our initial investment of 750. This is discounted payback period.